Today, I wanted to talk about the book that I've just finished reading, and it's called The Lords of Easy Money by Christopher Leonard. And I thought I just want to share my experiences about it, what are my key takeaways from it, and what I've sort of learned from the book after now that I've finished it. My name's Charlie. I make finance related videos, and if there's anything here you like, consider liking and subscribing, and I'll keep making content like this. Jumping right into my thoughts on the book. Why did I pick this book? So I originally heard about this book through a podcast I'd listened to that had Luke Belmar on it, and where he recommended a number of books to read that he thought would help people get ahead in life and understand how the financial system worked a lot better. And he mentioned the Lords of Easy Money book. I didn't really understand what it was about. Judging from a lot of his content, I thought it was something that it's like a tip or tricks to get ahead in life and make money easily. And I think that's sort of what the key takeaway from the title of the book is, The Lords of Easy Money. It's trying to make money quickly. But it's not that at all. And I often had to find myself explaining it to people when they ask me, oh, what book am I reading? And I'd explain to them, oh, I'm reading this book. And it's not exactly like a get rich quick book, but rather it's a book about the Federal Reserve and how the Federal Reserve implemented quantitative easing. And I think when I then explained it to people like that, they go, oh no, you're boring. But that's sort of how I originally heard of the book. And then I read into it a bit more just to say, well, what is this book? What is it about? And it sort of interests me just to understand the mechanics of quantitative easing. But one of the things that Luke Belmar said, it was to understand why the Federal Reserve implemented quantitative easing. And you sort of need to understand the game before you can get ahead in the game, which I'm not entirely sure I understood in the beginning, but it made a lot more sense as I was getting through the book. And really, what it was about is understanding how quantitative easing works and how you could actually apply quantitative easing into your ordinary investing life. So I don't think it'll come as a surprise, but what was the biggest things I learned through the book? And really, that was the mechanics of what quantitative easing is and when the Federal Reserve applied it. And I think it might just be, oh, that the Federal Reserve does this to implement quantitative easing. I think what was very nice about this book is how they went into the specifics of it, how the decisions were made, who were making the decisions, and the research that they followed before they made these decisions. And what's really nice about it is it goes into a lot of that critical thinking, and it lets you understand what people were thinking at the time and what they thought the outcome was going to be. But what's also quite fascinating is sort of what's been set as the norm with quantitative easing. So what it basically looks like is that the Federal Reserve now view quantitative easing as a set standard, and in any market outcome where there's something that they don't like, that they can simply open the taps or close the taps to get the desired outcome. And I think what was quite interesting is understanding the implications of what happens when you open these taps and close these taps. And one of those was asset inflation, which led to the big wealth gap that we see and the big inequality that we see in a lot of countries around the world. Because keep in mind, quantitative easing isn't just what happens in the US. It actually happens in a lot of countries around the world. So this sort of led me to think, well, what about the book actually shocked me about it? And it's understanding that the Fed implemented quantitative easing knowing what the problems were going to be. They knew that quantitative easing was going to cause asset inflation. And the book actually mentioned, and it was one of the key points I actually highlighted, and I've got a couple of notes on the side, not very many, but one of the things was that asset inflation was almost one of the goals of that, not really like a consequence. They knew it was going to happen, and they still went ahead with it, knowing that that was going to be an outcome. And I think that's part of the thing that sort of scares me a bit, is aren't these the people making decisions and understanding the research before they make the decisions? And basically, this asset inflation leads to what we see today being the big inequality that we see in countries. And coming from South Africa, that inequality is quite obvious, and I think it's becoming a lot more obvious in other countries. So it definitely is something that shocked me that they very much were aware of what it would do and the consequences of it, and they still went ahead with it. And I think when you look at it from a long-term perspective, quantitative easing also has other aspects to it. It can still lead to asset bubbles. We saw what's happened in previous bubbles, for example, the 2008 collapse and also the dot-com bubble in the early 2000s. So what's happening is we're basically stoking asset prices to a point where their values are beyond what's actually affordable these days. So it's one of the things also that sort of shocked me is the long-term effect that QE is having on economies and the bubbles that they are potentially creating. But how that plays out in future, I don't know. But it was just interesting to get a little bit more perspective on that, because it's always something I've always been interested in to learn more about. Would I recommend this book to anyone else, and to who would I? Basically, I wouldn't suggest that any random person read this book. It is not an easy read for someone who's not in the finance industry, because they use a lot of topics and things there that are very relative to the finance world. And if you don't understand some of them, although they do break them down really nicely, it often basically makes it less easy to understand the implications of what's happening. That's just one thing I found. So if you don't have an investing background, or you're not really interested in investing and you don't have a finance background, then I don't suggest the book is for you. But if you definitely have a finance background and you want to understand the implications that QE has, because the one thing we know nowadays is that you can't discount what the Federal Reserve does. And even in other markets, like for example, us in South Africa, before making decisions, we look to what the Fed is doing, even though we're not in that market at all. And even if you're from other countries, it's not something you can ignore either. How has this book changed the way I think about investing in markets? So I think one key thing is understanding risk. So we always talk about this thing where companies now are too big to fail. And what QE has showed us is that now is a reality. There are 24 dealer banks where the Federal Reserve uses their reserve accounts to deposit money in and to get money supply into the market. It's really interesting to know that the Federal Reserve will step in for those 24 banks at any time. And I think the other thing to see is that the Federal Reserve will step in whenever there's an outcome that they don't want. But I think one of the things that I noticed the most about the book was that the Federal Reserve has stopped looking at long-term trends and started focusing more on short-term trends. So they're focusing more on short-term things when they should be focusing more on the long-term effects, which I found really interesting. So the one thing I noticed is that basically you need to hold assets. In order for you to benefit, you need to hold assets. So you can't hold debt, because all it does is it multiplies. And it multiplies in the direction that you have. If you have assets, your assets grow, and they grow quicker, which we've seen over the last decade. Asset prices have significantly increased. But also likewise, so has indebtedness. The more debt you have, the faster it compounds and grows as well. So that's where the two key takeaways that I actually found from this book is you need to hold assets and you need to minimize the debt as much as possible. One of the other things I have a nice takeaway from is it now gives me another indicator to track to understand the general trend of the market. So now what I've created is a liquidity tracker where the Fed releases their balance sheet once a week, and I basically track that balance sheet to understand what's the Fed's position is. Are they increasing their liquidity, or are they decreasing their liquidity? And it's quite powerful to understand. If the Fed is increasing liquidity, then asset prices are expected to increase, and likewise, if they're decreasing liquidity, then asset prices are likely to decrease. But it's quite interesting also because you can look at what the Federal Reserve is buying, because then you can understand what the sort of goal is and their target. And what's quite nice is you can understand how much liquidity they're adding at a time or how much they're pulling out at a time. If it's slow and gentle, then it's part of a process. But if it's quick and sharp, it means that they're definitely trying to correct something. And you're going to see that come through. Obviously, QE has long-term implications, but we sort of just need to see how the Federal Reserve reacts and how the different federal heads of the Federal Reserve react as well. I think this also sort of gives rise to a new term that's not very unfamiliar in the finance market, but basically don't fight the Fed. If the Fed is trying to move the economy in a certain direction, it's probably better to hop on the boat and row with them instead of against them. And I think that is where you will be able to get ahead quicker with this, is instead of seeing warning flags sometimes, it's better to say, well, what is the Fed doing? Because often the Fed is going to step in if there's a problem. So if you are in the finance industry or like investing, then I definitely suggest reading the book. It is definitely worth it. And thank you for listening this far. If you found that interesting, be sure to subscribe because I'm going to keep making content like this. Cheers.